More than $100 billion in cash, stocks, paychecks, savings bonds, and life insurance payouts is sitting in government accounts right now, with specific names attached to every single dollar. The people whose names are on those accounts have no idea the money exists, and 1 in 7 Americans is owed something. About 10 minutes from now, I'm going to walk you through exactly how to check whether you're one of them. Before that, though, I want to explain how a pile of money this large just sits there, untouched, growing bigger every year, because the answer turns out to be one of the strangest and least discussed stories in American government. The number comes from the National Association of Unclaimed Property Administrators, the organization that actually tracks all of this across all 50 states. Their figure for state-level holdings alone sits at approximately $70 billion in unclaimed property. A decade ago, that number hovered around $42 billion, which means the pile has nearly doubled since 2014. And $70 billion only covers the states. Federal programs push the total well past $100 billion once you start adding them up. The U.S. Treasury alone holds more than $30 billion in matured savings bonds that nobody ever cashed. Every single year, over $1 billion in IRS tax refunds expires because the people owed that money never filed a return. The Pension Benefit Guaranty Corporation is holding more than $400 million in pension benefits that belong to over 80,000 workers who never collected. HUD owes $400 million in FHA mortgage insurance refunds to nearly 800,000 homeowners. Roughly $30 million sits uncollected in VA life insurance, and the NAIC's Life Insurance Policy Locator has connected consumers with over $13 billion in benefits since 2016, with billions more still floating unmatched across the industry. That total, once you combine every state treasury and every federal program, lands well past $100 billion with nobody coming to collect. The concentration is wild. New York alone holds somewhere between $19 and $20 billion spread across 84 million individual accounts. California holds $15 billion, Texas more than $9 billion, Pennsylvania over $5 billion, and Ohio roughly $4.8 billion. What makes this genuinely strange is that none of this money is abstract. Every dollar in the pile has a name attached to it, an actual person or their heirs who could walk up and claim it at any time. The average payout through missingmoney.com comes out to $2,080, though some claims land at just $100, and others end up changing someone's life completely. So what fills a $100 billion pile of forgotten money? The obvious categories come first. Dormant savings and checking accounts where someone moved across the country and forgot about $300 sitting in an old bank. Uncashed payroll checks, the kind that happen when your last paycheck from a job you left 8 years ago gets mailed to an address you moved away from. Utility deposits nobody bothered to collect. Vendor checks that went stale. Dividends from stocks people forgot they even owned. From there, the categories get stranger and the dollar amounts get bigger. Forgotten 401ks and IRAs, brokerage shares from companies that merged out of existence, annuities, court escrow funds, money orders, and mineral royalties from land your grandparents owned in Oklahoma 60 years ago. And then you get to the safe deposit boxes. When nobody pays the rental fee on a safe deposit box and nobody shows up to claim it, the bank eventually drills it open and turns the contents over to the state. What they find inside borders on unbelievable. States have reported pulling out gold bars, Tiffany jewelry, Civil War journals, a 17th century Bible, Purple Hearts, and baby teeth. Pennsylvania alone holds the contents of more than 1,000 abandoned boxes, and among those contents sits a Johnson Matthey 100-ounce silver bar alongside a 1908 St. Gaudens $20 Double Eagle gold coin. Somewhere in a Washington state vault, there's reportedly an 1860 Lincoln campaign button that nobody has come to collect. The most tragic category, though, and the one holding the most money, is life insurance. What happened here is genuinely infuriating. Over the last decade, regulators discovered that at least 25 major insurers, among them MetLife, AIG, and Prudential, had been using the Social Security Death Master file to stop paying annuities to deceased customers. That part makes sense because dead people shouldn't keep receiving annuity payments. The problem is that those same companies were not using that same database to pay out life insurance benefits to the families of those deceased customers. The insurers knew the policyholder had died, and they simply never told the beneficiaries. State regulators eventually forced these companies to refund $7.4 billion, but nobody knows how much remains unclaimed because the families never learned the policies existed in the first place. Sit with that for a second. A parent or grandparent of yours may have held a life insurance policy, passed away years ago, and the insurance company that knows they're dead is still holding the payout because nobody in your family ever knew to ask for it. The reasons money goes unclaimed turn out to be completely mundane, which is part of what makes the scale so staggering. People move. About 11% of the U.S. population changed addresses in 2024 alone, according to the Census Bureau, with renters and younger adults moving even more frequently. Every move severs a paper trail because the bank still has the old address, the employer still has the old address, and the insurance company still has the old address. A check gets sent, bounces back undelivered, and after a while the company just stops trying. Name changes at marriage or divorce break the link between maiden name accounts and a person's current identity. Corporate mergers and bankruptcies scatter shareholder records into oblivion. People die without ever telling their families about every account they opened over a lifetime, which, honestly, describes nearly everyone. And basic human behavior handles the rest, because a $76 utility deposit, which is roughly the average size of New York's expedited small claim checks, never feels worth chasing. Nobody picks up the phone over $76, and that money just sits, sometimes for decades. All of that money doesn't stay at the bank forever, though. At a certain point, it gets handed over to the government through a system with a name that sounds pulled straight from a medieval legal textbook, because that's exactly where it comes from. The system is called escheatment. Under English common law, property with no clear heir reverted to the crown, and the American version works on a similar principle. Every state has an unclaimed property law requiring businesses, whether banks, insurers, employers, or brokerages, to turn over dormant accounts to the state after a set period of inactivity. That dormancy period runs 3 to 5 years for most account types, drops to 1 year for wages, and stretches up to 15 years for things like traveler's checks. On paper, the state acts purely as custodian, holding your money until you come get it, with no expiration on your right to claim. The system was designed to protect people on the theory that the state holding your money beats a bank quietly absorbing it. That's the theory. Practice looks nothing like that. What states discovered is that unclaimed property functions as an extraordinary revenue source, because while they're supposedly holding your money in trust, they're spending it. Most states sweep unclaimed funds directly into their general fund, the same budget that pays for highways, schools, and government salaries. The math works beautifully for them because intake dwarfs outflow by an enormous margin. NALPA's own data puts the total returned to owners in fiscal year 2024 at about $4.5 billion, which sounds like a lot until you measure it against the $70 billion they're holding. That return rate lands around 5 to 6%, meaning 94 to 95% of unclaimed property stays with the state, year after year after year. California's return rate sits at just 3.5% of its $15 billion, and the roughly $1 billion a year the state collects from unclaimed property ranks as its fifth largest general fund revenue source. Since 2007, New York's comptroller has transferred $11.8 billion from unclaimed property into the state's general fund, a ratio that works out to roughly $5 swept into state spending for every $3 returned to the people it belongs to. And none of that compares to Delaware. Delaware is where this whole story crosses from strange into genuinely hard to believe, because this tiny state with fewer than 1 million residents has turned unclaimed property into a structural pillar of its government finances. The reason traces back to corporate law. More than 1 million corporations and 2/3 of the Fortune 500 are incorporated in Delaware, and a 1965 Supreme Court ruling called Texas v. New Jersey established that when the owner of unclaimed property can't be identified by address, the money goes to the state where the company is incorporated. That ruling turned Delaware into a funnel for unclaimed dividends, uncashed checks, and dormant accounts from corporations headquartered everywhere else in the country, from California to Texas to New York. At its peak between 2015 and 2016, escheatment supplied more than 13% of Delaware's entire state budget. The current share has dropped to about 7%, roughly $550 million in fiscal year 2024, and Governor Matt Meyer's most recent budget proposes raising the cap to $614 million. Delaware's collection methods haven't always been what you'd call restrained, either. In Temple Inland, Cook, a federal judge found that Delaware's auditors took a single unclaimed paycheck worth $147.30, then extrapolated it using estimation and a 22-year look-back into a liability of $2.1 million against the company. The judge's exact words described Delaware's practices as something that, quote, shock the conscience, unquote, calling the whole approach a, quote, game of gotcha, unquote. The MoneyGram case pushed things even further. Delaware had been claiming hundreds of millions in uncashed money orders, arguing that since the money order company was incorporated in Delaware, every owner-unknown money order belonged to the state. 30 other states objected, and in February 2023, the Supreme Court ruled 9-0 against Delaware in an opinion written by Justice Ketanji Brown Jackson, redirecting $300 to $400 million in escheated checks to the states where they were actually purchased. Delaware ultimately paid $102 million in settlement and surrendered another $89 million in escrow. The next time someone describes Delaware as just a small state with no sales tax and a lot of chickens, keep in mind that it also figured out how to convert your forgotten checking account into a government revenue stream. Statistics can only carry a story so far, though, and the stories of real people who discovered this money are what make the whole system feel concrete. The single largest individual unclaimed property return in United States history belongs to the estate of Joseph Stancack, an 87-year-old bachelor who lived alone in Chicago with no will, no spouse, no children, and 6 siblings who had all died before him. When Stancack passed away on December 23, 2016, he appeared to have almost nothing, and his only known indulgence was a small boat he'd named Easy. 6 years after his death, the Illinois State Treasurer's Office, using a data matching system called iCash, discovered that Stancack had quietly accumulated $11 million. Finding his heirs required tracing a family tree that stretched back 5 generations across multiple countries. The state eventually tracked down and distributed that $11 million to 119 distant cousins scattered across Poland, Slovakia, the Czech Republic, Germany, the United Kingdom, Canada, and 5 U.S. states. One of those cousins, a retired oil sands worker in Canada, received the notification letter and assumed it was a Nigerian prince scam. That's the record holder, but the everyday discoveries might be even more striking. An elderly woman named Barbara in Bradenton, Florida, nearly tossed a letter from the state into the trash because she assumed it was a scam. A police officer doing a wellness check at her home helped her open it, and inside was notification of $108,000 in stock dividends from a phone company she'd worked at 31 years earlier. State treasurers have taken to publishing lists of famous names with unclaimed property as a way to drive public awareness. Massachusetts has held funds in the names of Tom Brady, Bill Belichick, and David Ortiz. New Jersey maintains listings for Taylor Swift, Meryl Streep, and the state's own Governor Phil Murphy. In May of 2024, Florida's chief financial officer Jimmy Petronas publicly invited Donald Trump to claim $54,000 in unclaimed property held in his name. None of these are anomalies. This is the system functioning exactly as designed, where people forget, companies lose track, money accumulates, and the government holds it until somebody asks. There's a darker dimension to all of this that rarely gets attention, and it centers on what happens when the government doesn't just hold your property, but sells it. Most states liquidate financial assets like stocks the moment they take custody, converting shares into their cash equivalent. That approach sounds reasonable enough in the abstract, right up until you hear what happened to Jan Peters. Peters, a German aerospace engineer, joined a major tech company as employee number 68 at their Munich office and accumulated 1,029 shares of that company's stock in a brokerage account. California seized those shares under its 3-year inactivity rule, classified them as abandoned property, liquidated them, and mailed Peters a check for the sale price at the time. The company's stock kept climbing after that. By the time the full picture became clear, Peters had lost approximately $2.6 million, compared to what those shares would have been worth, and his case now sits pending at the Supreme Court. His story isn't isolated. Liana Barf, a South African retiree from a major tech company, lost roughly $2 million when Delaware liquidated her 4,326 shares under an abandoned property designation. Two French chemists lost approximately $12 million when Delaware sold their pre-acquisition stock in 2009 without giving them notice. Cases like these are driving real legislative action. In 2026, Representatives Sam Liccardo and Mike Lawler introduced the bipartisan SAFER Act, which would bar states from liquidating securities and digital assets while the owner is still alive. California's SB 822, signed by Governor Newsom in October of 2025, became the first state law to prohibit forced liquidation of cryptocurrency, requiring it to be transferred to custodians in its original form rather than sold off. The natural question after all of this is why the system hasn't been fixed already, and the honest answer is uncomfortable. The entities holding the money benefit financially from holding the money. California's unclaimed property ranks as its fifth largest revenue source. Delaware funds 7% of its state budget with escheated funds. New York has swept nearly $12 billion into general spending since 2007. The structural incentive to aggressively track down owners and return their money is, by any honest accounting, weak. Critics, including the California Legislative Analyst's Office, have said as much in writing. Change is coming, though, and Illinois has been leading the way. Their enhanced money match program uses tax record matching to automatically identify owners and mail them checks with no claim required. One recent round put $45 million into the hands of 600,000 residents. Illinois set a $303 million annual record for returns in fiscal year 2025, marking their 10th consecutive record year. Wisconsin now auto-issues checks for unclaimed amounts up to $2,000, and North Dakota does the same for amounts up to $1,000. Federal attention is building too. On April 15, 2026, Senator Elizabeth Warren formally demanded state-by-state escheatment data from NIUPA, citing the gap between the $4.5 billion returned annually and the $70 billion held, with a May 1st response deadline. A CBS investigation into California's $15 billion hoard prompted federal lawmakers to begin drafting legislation that would force states to adopt proactive return methods. The system is cracking slowly but visibly. Everything up to this point has been interesting, but this next part is the one that could actually put money in your pocket tonight. Searching for unclaimed property is always free. Every single legitimate database charges nothing. If anyone contacts you by text, email, or postcard asking you to pay a fee, hand over your full social security number, or wire money to quote release, unquote your funds, that is a scam. Even legitimate licensed property finders are typically capped at 10% by state law and cannot contact you about property held less than 2 years. Here is where to look. Start at missingmoney.com, which is run by NAPA and searches multiple state databases at once. Enter your current name, your maiden name if that applies, and any previous names you've gone by. After that, go directly to the unclaimed property website for every state you've ever lived in, because property follows the address on file, not your current address, meaning your money could be sitting in a state you haven't thought about in 20 years. For federal money, check irs.gov/refunds for unclaimed tax refunds, keeping in mind there's a 3-year window to claim, and the April 15, 2026 deadline covers tax year 2022, with roughly $1 billion at stake. Head to treasurydirect.gov if you or your parents ever bought paper savings bonds, because $30 billion in unredeemed bonds covering roughly 95 million individual bonds is sitting there waiting. For deceased family members, the NAIC Life Insurance Policy Locator at eapps.niq.org searches across participating insurers for free to check whether an unclaimed death benefit exists. Check pbgc.gov if your relative ever worked for a company with a pension plan that was terminated, because individual unclaimed pensions in that database range from 12 cents all the way up to almost $1 million. HODI's FHA refund search covers old mortgage insurance premiums. The FDIC's closed bank database handles deposits from failed banks and USA.gov/unclaimed money serves as the master federal directory linking to all of these resources. The Department of Labor also launched a tool in 2024 at lostandfound.dol.gov, specifically designed to locate orphaned 401k accounts left behind at former employers. Search every name you can think of. Search maiden names, deceased relatives, your parents. California's state controller says 1 in 3 Californians finds a match when they search their database, and NAPA estimates 1 in 7 Americans overall are owed something. The thing I keep circling back to is that the most surprising part of this story is not the size of the pile. What's really striking is how narrow the gap is between abandoned and claimed, and that gap, for most people, amounts to a search bar. Joseph Stankak's 119 cousins didn't earn that $11 million. Somebody looked. Barbara in Bradenton nearly threw $108,000 into the trash because she thought it was junk mail. Jan Peters lost $2.6 million because nobody informed him that California had seized and sold his stock. States carry a financial incentive to keep your money rather than return it. 50 separate state databases and a dozen federal agencies fragment the system into pieces. Dormancy periods keep shrinking, and stocks are getting liquidated at prices that bear no relationship to what they'll be worth in 5 years. But this is one of those genuinely rare situations where watching a video can lead directly to money in your account. Not eventually, not in theory. Tonight, open a tab, go to missingmoney.com and type in your name. The whole search takes less time than this outro. Your odds of finding something sit better than 1 in 7. What you find might be $76 or $2,000 or $108,000 in stock dividends from a job you had in the 90s. Whatever the amount, it belongs to you and always has. Nobody is coming to find you, though. Go get it.